On July 7, 2026, global markets underwent a broad dislocation. The South Korean KOSPI dropped 8% intraday, triggering a wave of selling that pulled the Nasdaq down 1.2% and forced the Dow Jones Industrial Average off its record 53,000-point peak. This volatility followed an extraordinary fundamental catalyst. Samsung Electronics, the linchpin of the Korean tech sector, announced its preliminary second quarter results, revealing an operating profit surge of approximately 1,800% over the previous year. Yet in the hours following this historic earnings beat, Samsung's stock fell nearly 7%, erasing billions in market value and pulling the broader index into a tailspin. Simultaneously, the U.S. market faced its own contradiction. SpaceX, less than a month after its $75 billion IPO, was fast-tracked into the Nasdaq 100, a move that legally required passive index funds to purchase $4.3 billion of its shares. Despite this guaranteed injection of capital, SpaceX shares dropped 5.2% in their first official session as an index constituent. These simultaneous sell-offs suggest a shift in market behavior, one where the traditional relationship between corporate performance and share price is beginning to be overridden by mechanical mandates and automated logic. To understand why these assets are moving in opposition to their earnings, we have to look past the corporate reports and track the specific flow of capital through the exchanges. Determining the cause of Samsung's decline requires an examination of the specific unit economics within the semiconductor sector. This chart tracks DRAM's sequential price growth. Analysts projected 40%, but actuals reached only 30%. This deceleration comes from long-term agreements. These stabilize prices, but place a fixed ceiling on supplier profit margins. Samsung's upside is now mathematically capped. This data aligns with a broader cooling in the AI sector. The LLM Token Expenditure Index, which measures spending on large language model usage, has fallen 20% from its peak in May. For institutional investors, these two metrics signal that the rapid infrastructure-building phase of the AI cycle is transitioning into a more capital-disciplined period. As the hardware market moves into this maturity phase, investors are beginning to re-rate technology valuations, focusing on actual cash flow rather than just explosive capacity growth. While the fundamental re-rating provided the spark, mechanical factors amplified the damage. On July 7th, foreign institutional investors sold 3.36 trillion won, roughly $2.19 billion of Korean equities. This selling hit a domestic market that was already low on liquidity. Retail cash reserves held at brokerage firms had recently dropped from 137 trillion to just 118 trillion won, leaving few buyers to absorb the shock. The pressure reached single-stock leveraged ETFs, programmed to maintain a strict 2x leverage ratio daily. When the underlying stock falls, these funds must sell more to deleverage. This creates an automated cascade, where selling triggers more selling, regardless of earnings. On July 7th, this reflexive selling accounted for over 1/3 of all ETF transaction volume, eventually plunging the KOSPI by more than 8% intraday. The decline was only halted when exchange regulators triggered a market-wide circuit breaker, suspending all trading in the afternoon to prevent a total collapse of the index. In environments with limited liquidity, these algorithmic mandates can completely disconnect a stock's price from its actual value, turning a routine sector rotation into a flash crash. A similar disconnect occurred in the U.S. Following its $75 billion IPO, SpaceX was fast-tracked into the Nasdaq 100 under new rules that shortened the waiting period for massive new listings to just 15 days. This inclusion created a mandatory buy order. Funds that track the index were legally required to purchase $4.3 billion of SpaceX equity at the market close on July 6th. But the supply of shares was extremely limited. While CEO Elon Musk retains 49%, only 4% of SpaceX equity is available for public trading. Active traders recognized this predictable window, dumping their positions directly into the index fund's mandatory buys. Because the sell orders from active managers outweighed the mandatory buying from passive funds, SpaceX shares fell 5.2% on their first day in the index. This highlights the instability of a $2.1 trillion valuation that is tied to a very thin public float and a company that reported a $4.2 billion net loss in the first quarter. Passive indexing rules, when applied to companies with limited public shares, can create liquidity traps, distorting prices and allowing active frontrunners to capitalize on the index's lack of flexibility. These structural failures are now colliding with a broader macroeconomic bind. On the same day, Iranian forces launched projectile and drone attacks on 2 commercial tankers in the Strait of Hormuz, the Al-Rekayat and the Wedyan. These strikes were designed to disrupt the southern Omani transit route and force international shipping back into lanes where Iran maintains direct military oversight. This geopolitical risk caused Brent crude to spike 2.5% intraday. This keeps global energy costs high, even as U.S. core CPI remains flat at 2.9%. This persistent energy inflation is occurring just as the U.S. labor market begins to cool. In June, the economy added only 57,000 jobs, less than half of what analysts expected. This creates a policy trap for the Federal Reserve Chairman, Kevin Warsh. He must choose between supporting a slowing job market and maintaining high interest rates to combat energy-driven inflation. When geopolitical conflict continues to drive baseline inflation, central banks lose their ability to lower rates and stabilize the equity markets. The events of July 7th mark a convergence of capped semiconductor margins, passive liquidity traps, and a central bank constrained by inflation. This combination of structural volatility and restrictive macro policy is driving capital out of mega-cap technology and into sectors with uncorrelated growth. One major beneficiary has been the biopharmaceutical sector, as seen in Vertex Pharmaceuticals' $10 billion cash acquisition of Crinetics. Vertex paid a 102.2% premium to secure palsonify, a drug for rare endocrine disorders. This move allows the company to diversify its revenue away from its core cystic fibrosis business. Unlike the hardware market, rare disease therapies offer high margins and a reliable revenue stream that is largely insulated from broader economic shifts. In an environment defined by high yields and slowing growth, institutional investors are increasingly demanding assets that can provide defensive, predictable results. As liquidity narrows and geopolitical shocks persist, passive indexing alone no longer guarantees stability. Navigating this environment requires a focus on uncorrelated growth and strict fundamental execution.